Welcome, everyone. This is another edition of really just sharing some amazing opportunities with you in real estate. And one of the things that's always been important to me is to give my clients the competitive edge. Just knowing and understanding real estate gives you the opportunity to do things that most people are unaware of. And in some cases, real estate agents, real estate professionals are not even aware of. And this is just another one of those opportunities. And I'm actually joined today with a friend, colleague, and just a superstar in the mortgage industry, Mr. Kenny Green. He's the vice president of mortgage for Rate Mortgage. And he's going to be sharing some powerful information with you in regards to assumable loans. And we're going to talk just briefly here about assumable loans and how this can really take your business to the next level. So I wanted to bring on one of the a consummate professional in regards to that area. You know, he's done all types of loans, whether it's VA, whether it's down payment assistance, and he's doing the loan that really no other mortgage broker can do, and that's the assumable, the second mortgage to an assumable. So we'll talk more about that as we're going through the presentation here. But let's just talk about, assumable loans and having a clear understanding of what assumable loans are. And let me just tell you a little bit about myself. My background is, 26 years in law enforcement, Gulf War veteran. Been in real estate since 2001, been a business owner since 1997, a best-selling author of three personal development books. I'm a mindset and a brand awareness coach and the founder of a real estate organization called the Super Agents Collaborative that has 120 plus agents, part of that group now as well. And so let's just jump right into assumable loans. So some of you may be asking yourself, what is an assumable loan? And this is going to be a concise, quick, but comprehensive understanding of what assumable loans are and how you can make them benefit for yourself. So first and foremost, what is an assumable loan? It is the ability for a buyer in 2025 right now to be able to assume the loan of a homeowner that may be selling their property. And if they have a particular type of loan, you would be able to assume not only their loan terms, but which means the interest rate, which means the number of years. If they've had the property for 4 years and it's a 30-year mortgage, well, guess what? You only have to pay for 26 years because you're assuming what they have already paid. Here's where the beauty lies in it, though. If they bought in, say, 2020 or 2021 at these amazing interest rates that we had of, 3.75 or 2.5%, and they have that potential particular interest rate locked in for the life of that loan, and you can come in and assume that particular loan. So that's where it really gets beneficial for a buyer in this market when we know that we're dealing with 6.5, 6.8, 7%, depending on circumstances. So a much higher rate that you would be dealing with compared to if you can assume someone's loan. Now, not all loans are assumable. The main thing that you have to understand with assumables is it only comes down to USDA, VA, and FHA loans that can be assumed. And in most cases, what you're probably going to find is that the assumable that you're going to be looking at the most is a FHA loan. In some instances, if you are a veteran, then yeah, it definitely opens up the opportunity to also be able to assume a veteran's loan. One unique thing about assuming a veteran's loan is you typically have to be a veteran. I've only had one scenario where I had a veteran that owned the property and was selling under the assumable circumstances, but the buyer was not a veteran. And in that particular case, because of the circumstances with that veteran, they were willing to give up their rights to their VA benefits. And so they don't give them up forever, but they do give them up for the life of the time that that buyer owns that property. And once they assume it and they continue to pay into it, If they refi it for whatever reason, then the veteran will get their benefits back. If they sell the property, then the veteran will get their benefits back. But until that happens, the buyer that is a non-veteran basically now has those VA benefits. So as you can see, if you're a veteran, you know how valuable those VA benefits are to you, and most veterans are not willing to give that up. Now, it all sounds great when you think to yourself, okay, there's a house on the market that fits within my price point, and I can get it at 2.75. That all sounds great. So you got to be thinking, well, what's the catch? Well, it's not really a catch. It's just the facts of the matter. You got to remember that those folks, when they bought that property, say in 2020 or 2021, they bought it at a particular price. They've been paying on that property during that time. So now they're at a point where they have a certain balance on the property. Let's say they bought it at 425,000, and in the course of the last 3 or 4 years, they've paid it down to 400,000. Well, the value of that property has gone up. So let's say the property is worth 500,000. So now you have a property that you can take over the interest rate. It has an interest rate, a great interest rate, but the difference between that 400,000 and that 500,000 has to be made up somewhere. So you're assuming the first mortgage, you're assuming that loan, but there's $100,000 difference that the seller is expecting to get paid because that's what the property is now worth. So if you are a buyer where you have an extra $100,000 that you can just put down on the property, then it's absolutely no problem. You can do it. And now you're assuming the loan with a $400,000 balance, and you're getting the great interest rate. And if they've paid 4 years into it, you only have 26 years left to pay, and all is well. All works out great. We're going to talk in a minute about if there's a situation where you don't have those funds, and that's where Kenny comes in to be able to still make this a doable deal and transaction for you. So again, that's where we're bringing in a mortgage company, it says companies on here, but I can tell you I've been doing assumables since 2022, and I've only found one company, and that's Rate Mortgage, that has been able to actually do the second on an assumable. So what does that mean? That basically, Kenny is going to go into more detail, but that basically means Kenny is going to say, hey, if you don't have that whole 100,000, we're going to be able to help you with that. So with that being the case, Kenny, I'm going to go ahead and turn it over to you, sir, and you can take it from here, and I'll get your slide up.
Yeah, thanks, Barry. Thanks for the introduction. Yeah, as Barry said, we one of very few companies in the Denver metro area, just pretty much in Colorado as a whole, that actually can do a assumable loan. The best thing about this program, our loan program, is a portfolio loan. So what that means is we service these loans, so you don't have to worry about making multiples of different payment. We service all of these loans. The best thing about this program also too, you don't have to put down 10% of the amount that is being assumed. You got other companies out there that want you to put 20, 30% down. But this program, you don't have to put down 10%. And the best thing about this also too, the minimum FICO score that is required is a 680 FICO. Um, for us better do this loan for you. And the best thing about it is also too, this is not just a single family home. You can do this for condos. You can do it for fourplex. You can do it for duplex. So if you do have investment property out there that have low interest rate, you want to assume that loan, we can do this for you also too. And if you do have a co-borrower, they do not have to be an owner occupant. So you can, if you're trying to have someone else to go on a loan with you, they do not have to be in living in the home also too. And this program follow all the Fannie Mae guidelines. What does that mean? It doesn't mean we don't have like any extra overlays. So we're going to collect the basic documents from you, your paycheck stub, and the past 30-day pay stub, your bank statement, W-2s. If you are 1099, we'll request your 1099 also too. So those are the most simple documents we do need from you as far as trying to get the assumable loan done. One thing I really like about this also too, if the 10% you do plan on putting down, that funds, we we do not have we cannot ask you where that funds came from. As long as you have that money, there will be any question from the underwriter asking you where did that funds come from. So as long as you have the funds for that 10%, we should be okay to get this loan going for you. And we can go up to $1 million as far as like on these assumables. I mean, if you assume $1 million, great, but we can assume that amount as long as you have the 10% to put down. And then, as I was saying, this loan is like a full doc. We follow all the Fannie Mae guidelines, and as I said, just simple docs, W-2, 1099, your pay stubs in the past 30 days. Those are those are the basic documents we do need to get this loan done for you. As I said, we work with an investor. Symmetry is the investor for us, even though it's a portfolio loan, but this loan is served by Symmetry. Every contact point of contact will be between me and the agent. So what I require upfront is the agent has to call the current servicer for that loan to see if that loan is assumable and what documents they'll be needing from us to assume the loan. Because even though the loan, every FHA loan might be assumed, some servicers will not service the one to assumable at all for some reason. Some of the loan companies that I've done, some of the loans I've done in the past, I had the best luck with. I had great luck with Loan Depot. That was not any problem at all. We got documents up from where the closest loan within 30 days. And we did Mr. Cooper. Those are some of the lenders that I have worked with in the past that was able to do assumable loans. But I always recommend the listing agent or the seller call the uh, um, the current mortgage company or the servicer upfront, asking them to see if they can assume the loan and what documentation we will be needing to get that loan assumed. If we can get those upfront, we can get these loan closed for you within 25 to 30 days. So again, the seller of that property always have to initiate a contact with the servicer, asking them what documents they need upfront. If they do need my help, I'm always here to help them get the documents upfront. Once we figure out what documentation we'll be needing from the seller, I will then go and I will start the process as far as like collecting every necessary documents that is needed to get the loan submitted to Symmetry. We'll be collecting a full credit application from you. What that means is I will have to pull your credit and I'll do the verification of employment, and then I have to collect your bank statements and everything else to get this loan to the finish line. So yeah, okay. And then once we get all the documents submitted, Symmetry will then go and start the approval process. And then you also have to be qualified with the current servicer. So even though we just give you the funds to get this loan assumed, you still have to be qualified with the current servicer. So they still have to pull your credit also to on their end, and they will have to get the loan approved on their end. Once that loan is approved on that end, they're going to send us a thing called a title. So what that means is the title, they're going to transfer title from the current owner to you. Once we get the documents, then on our end, we can then start the process as far as trying to get the loan closed on our end. As I said earlier, if we get all these documents upfront, I try to be proactive than reactive. That's why I always have the agent or the seller call the servicer upfront to collect every single documents that we do need upfront, so that way there's no stall in the process. And I ran a couple of scenarios here for you guys. Let's just say hypothetical. Barry was saying on a $500,000 price point, I ran a couple of payment options for you guys. Keep this in mind. The reason I really like this program a lot, the first 5 years of the assumable is interest only. You are not paying any amount to the principal. So the scenario I have here for this scenario is based on a $500,000 price point, and you will be assuming a $350,000 loan. So I ran that scenario with a 700 FICO score, hypothetical, $100,000 times 9%, you divide that by 12, you will have a monthly payment of $750. So every single month, that'll be your monthly payment on this loan until you can actually pay off the loan or get the loan refinanced. So the first 5 years, you're not going to have any interest rate floating. I mean, your interest rate, you have that same payment as constant as it can be for the first 5 years. And then after that, the loan will then default to a 30-year mortgage, but you already have paid 5 years upfront. So you're not going to be financing 25 years for the rest of the loan. If you do refinance the loan, there is no prepayment penalties. You're just going to just pay off the similar amount. And I think it's a great program for a lot of buyers out there because with interest rate being pretty high, you can definitely take advantage of the low interest rate out there right now. Barry there?
All right. Okay. So yeah, thank you so much for that, Kenny. And just to kind of close things out, let's talk about, get Kenny touched on this, but let's talk about it from the perspective if you're a seller and you are looking to have someone assume your loan. And then we're going to talk about it from the buyer standpoint as well. But the first steps, if I'm your agent and we're looking to do an assumable, first thing I'm going to have you do is call, if I know you have an FHA or a VA, we're already covered there. The next step will be to ensure that your loan service provider does allow for that loan to be assumed. So I'm going to have you call that mortgage company and find out. They will be able to let you know. They'll probably send you to the Assumable Loans department, which is always a good sign. And that they will basically be able to let you know what the steps look like. They'll be able to give you a time frame of how long the process will be. And that way, now you have confirmed that your loan is assumable. And then from that step, we'll be able to, once we get it under on the market, we'll be able to advertise it as assumable. And then when we get it under contract, we'll be able to plug the buyer right in. Now, the buyer's role when they are looking to assume a loan, as Kenny had mentioned, you have to qualify for the loan just like you would for a new loan. So you're going through the exact same process that you would as if you were getting a new loan. Because they want to make sure that you're going to qualify. Here's the beauty of it, though, because if you probably already qualified at the price point that you're looking at, because you wouldn't be looking at houses with an agent if you weren't already qualified. If you qualify at say 500,000 at 6.5%, you're definitely going to qualify if they have a 3% or a 2.5% or whatever the interest rate is. If it's lower, that means that your mortgage payment is lower. And more than likely you're going to qualify if you're already qualified. So that's not going to be an issue. Now, you will have some documentation that you have to fill out for that lender that will is the that you're assuming with, just like you did when you were getting the new loan amount. So nothing really changes from there. Again, the timeline for this, when I first made this presentation a couple of years ago, it was a 60 to 120 day process. Reason being because assumables 3 years ago were relatively new and they didn't have a whole lot of staffing in those departments. Because it's become a thing, most loan service providers now have more staffing and they're going through the process a little bit faster. I've seen it as short as 30 days. From the time we go into contracts to the time that we close. But there are still some instances where it may be 45 or 60 days before it can be completed. So hopefully all this information was helpful for you. Again, this is an amazing strategy if you are looking to get into a home and you're struggling with these higher interest rates that are creating the high $3,000 or $4,000 a month mortgage payment, and you want to put yourself in a more reasonable mortgage payment. I highly suggest looking at the assumable loan opportunity. So definitely reach out to myself or Kenny, and Kenny's phone number is there. Feel free to hit that QR code to get all my information, and we would love to have a conversation with you and develop a game plan for you moving into the future of buying a home and getting an amazing interest rate. Thanks everyone for being with us today. You have a great day.